Good morning, everyone. I am CA Manosa, moderator for today's Valuation Manthan session 38, organized by Valuation Standard Board of ICI. We are delighted to welcome you all to an enriching journey through valuation expertise. It is my pleasure to be the moderator in Valuation Manthan session 38, scrutinizing projected financial for valuation, organized by Valuation Standard Board of ICI under the leadership of our dynamic chairperson CA Hansraj Jugsar and Vice Chairperson CA Preeti Parasawla ma'am. Without further delay, let us start our today's session by welcoming the Honorable Chairperson of the Board, CA Hansraj Jugsar, for the opening remarks. Up to you, sir.
Yeah, thank you, Manoj. I, on behalf of the team at the Valuation Standard Board and on my own behalf and on behalf of the Vice Chairperson Preeti Savla, welcome each and every participants from the nook and corner of the country and some maybe beyond the border of the country even. We also welcome at the same time the learned speaker of the day, Anjan Babu, who will be deliberating upon how to scrutinize projected financials for the valuation purpose and bringing out best out of the quality valuation and the other aspects related with the valuation things. You see, like this journey of the valuation manthan has been started long back and continuing on each and every Sunday. Though Sunday normally we talk about is a day where one has a little easy, but our professionals always speak about in as per our motto of our ICI also, for the hunger for the learning, best to be performed, best to be given back to the whatsoever the job is been assigned with, and the valuation is a upcoming area, rather area which we look forward with the size of the economy growing with. So this valuation profession is bound to grow many newer opportunities in the different aspects, whether starting from the startup aspects, whether it is other aspects going forward for the IPO and how the financial statements and these are the major impacts which we find with. And your valuation standard board is doing wonders. Our vice chairperson will be sharing with each one of you how the journey of the valuation standards has been taken during this year, more particularly to the next level. With this initial remarks, I welcome each and every participants. I welcome the speaker Anjan Babuji, the moderator of the program Manoj Saji, and thanks to the team at the office at the secretariat, Dimple and the Rahul, and the tech team, those who have brought this on a continuity, this 38th program in the series, 38th Sunday, for the benefit of the each and every members. I welcome again to each one of you. Now I'm back to the Manoji on maybe requesting our vice chairperson to deliberate upon and share her word of wisdom for the benefit of the valuation board. Thank you.
Thank you, sir, for inaugurating the session and directing us in the right direction. We have with us Vice Chairperson of the Board, CA Preeti Parasawla ma'am, with us for the special address. Up to you, ma'am.
Thank you, Manoj. And very respected Chairman of Valuation Standard Board, C. Hansraju from North. And I can see Mr. Anjan Babu, the speaker for the day, and all dear participants on this last day of the year, Sunday morning. So I welcome all of you on this eve and wish all of you a very happy new year 2024, the year upcoming in the Amrit Kal of Institute of Chartered Accountants of India, because we are in the 75th year of the ICAI, and valuation is also growing leaps and bounds of institute in this era. So this is the 38th series, and very soon we'll be completing our Golden Jubilee. And in this ICI year, we wish to complete our Golden Jubilee, that is the 50 sessions of Valuation Manthan series. And I also thank all the participants for giving a great response to our series. About more than 1,000 participants are always there, and we are also keeping this sessions online. So you can access these sessions online at any point of time. And we are receiving very good responses. Members are calling and messaging. These sessions are really very good and enriching the knowledge and supporting in the valuation practice also. So we look forward to have more sessions interacting with all of you. And I also once again wish all of you a very, very happy new year and wish this last day of this year also a great Sunday. Uh, with these words, once again, welcome all of
Thank you, Preeti. And I also would like to convey my best wishes to each and every participants for the new year. Going forward, 2024 must bring something good in the life of each and everyone. The power of the, whether we talk about the, and naturally so many good things which we expect with the growth of the economy, more particularly to the each and every professional, so will be the year ahead will be the best of the year. And the many a time we talk about the spiritual power, and going forward in 2024 our nation is bringing so many good things for the nation also, so many good things for each and every citizen of the country also. So look forward the best of the journey for our country, best of the journey for our profession, and best of the journey for our professional around us. So my best wishes for 2024 New Year, and wish everyone the best of the life, and convey my wishes to their family also. Thank you very much.
Thank you
Over to you,
everyone
Manu.
for sharing words of wisdom with us. Today we have with us speaker of the session CA Anjan Babu sir, founder and partner of Agraga. CA Anjan Babu is a FCA holding DISA and is an IBBI accredited registered valuer. His expertise lies in the in-depth knowledge of valuation practices, market dynamics, and percent for meticulous research. He has over 10 years of experiences in the valuation, financial, and regulatory domains, including at a large CA firm servicing Pan India. Anjan sir earlier used to deliver guest lectures at professional forums such as ICI and BBA and colleges such as Christ University, St. Joseph College of Commerce, and Aurobindo College. He has two published papers on valuation of early stage startups attributed to his name. Sri Anjan Babu sir is a cheerleader for young professionals actively contributing to India's growth story. He believes success is the true success only when it results in a net good for financial advisory profession, society, and the nations. As our dignitaries briefed about the topic, now we will be hearing from our expert speaker, C. Anjan Babu sir, on scrutinizing projected finances for valuation. Up to you, sir.
Thank you, Manoj, for such a warm introduction. And my congratulations to Chairperson Manoj and Madam Chair, Vice Chairperson Preeti for having a commendable year and taking valuation standard boards to next levels. And I wish you all the very best in and also offer in any volunteer way I can support the valuation standard board for the coming year so that it can reach next greater heights. So in today's session, we will be talking largely about projected financial statements and financial modeling. I'll share my screen in a little bit, but there I would like to make a confession, a mistake as a valuer that I have been doing over the past. I've been a valuer for 6 years, and 4 out of those 6 years, I have made one mistake, which I hope the other professionals learn from my mistake, which is that I used to give undue attention most accurate risk-free rate, or checking whether my equity risk premium is the most optimum equity risk premium. Is it the most accurate one? Or my beta, is there a problem in my beta? Um, what are my weights that I'm considering for my debt equity. So these are the kind of uh, detailed thought process and in-depth views into discount rates I used to go into, with by ignoring the elephant in the room. I would like to say that there is an elephant in the room, and discount rates are a small part of the room. And the elephant in the room are the free cash flows. You can fine tune how much ever you want of your discount rates, but in the end, if you have not scrutinized your free cash flows, if your free cash flows are not reflecting reasonable reality, then there is really no way we can actually get our valuation right. Let me just quickly present my screen and yeah. So at this juncture, I would like to evoke the legendary Professor Damodaran. I think for many of whom he has been the Dronacharya for us being Ekalavya. Without him, without us meeting ever him, we would have learned a lot from his videos and his books. So I would like to evoke a famous quote of his. When you mess up your valuations, it is because you get your cash flows wrong. Um, so this is one, it hit me very soon when I heard this quote from him, that everything else is a technicality, everything else is a minority in your valuations. And if you can also take his wordings, right? When you mess up here, it's almost like a certainty. He doesn't say if you mess up in your valuations. He says when you mess up. So it's almost like a certainty. So it is an admittance, maybe from his part, from his experience, and also casting a judgment on all of us who are valuers, that at some point in time in our careers, we will end up messing up in our valuations. And it has ever hardly got to do with the technical parts of discount rate or how much DLOM did I apply, but rather more of did we get our projections right? Were there errors in projections? Were the projections reasonable? So when we make the mistake in valuations, it's usually cash flows. Cash flows, of course, when I say cash flows, it is implied that it is projected financial statements. So the agenda for the day, we will take it like this. Earnings and everything that is in relation to income statement, we will be assessing it first. Post that, we will be looking at the balance sheet items, also the financial position of the company in terms of projections. And then finally, we'll have a Q&A session. Q&A will also be there in between. So feel free to type out your questions and I will be receiving them as and when they are available through the moderator. So why are we starting from earnings analysis, or why are we looking at income statement in the first? Uh, so if you look at the fundamentals of preparing a financial model, when I mean financial model, I will also be using the word financial model synonymously with business plan or financial projections or free cash flows. I use these words synonymously because for me, in today's context, in the purpose of our session today, all of this hold synonymous value. So the financial model, when you look at it from a preparer's point of view, that is, if you have ever gotten your hands dirty and prepared a financial model from scratch, you will soon come to realize the first most fundamental thing is the ability to project the operations of the company on for a particular time period, be it a particular day, a week, a month, or a year. uh, it all starts from understanding what the company can do within that year or that time period. So when we do that, we look at various aspects. Like if you're talking about a traditional manufacturing company, you're looking at something like, say, what is the production capacity? If you're looking at a startup, it comes the reverse way around. I have unlimited growth. So that this is the philosophy of new age startups, right? I have unlimited growth. I'm only limited by the dry powder that is available. Dry powder is a term that is used in the urban VCPE dictionaries, which essentially mean how much money is available at disposal. So unlimited growth, only limited by dry powder that is available. So what can be achieved over the next financial year changes from a company to company, industry to industry, and sometimes even the risk taking capacity and ability of the promoter, amongst other constraints that are, as we all know, that is there in the macroeconomic situation. That is, Russia Ukraine war happens, there is a certain shrinkage in the economic activity, or COVID-19 and things like that. So those are the macroeconomic constraints. But when it comes to the individual company constraints, you can actually filter down on all the limitations that will stop a company from achieving unlimited growth. Uh, so when you look at it from that point, the most logical starting point is that your ability to predict the next year turnover or the following year turnover, because that is the most fundamental thing. You have all the basic things ready at the end of a particular financial or a period to understand or to estimate. I won't even call it projection, to estimate the next 365 days. Anything I believe after that happens over the next 365 days is a projection, where you have to assume certain uh, assumptions. You need to have a certain, you need to test out reasonable on a as you grow. So earnings analysis is the you look at the balance sheet. The balance sheet, all the line items that are there has some relation to the items in the P&L. If you're talking about current asset and current liability, they are like directly relational with the items in the P&L. There is no dispute about it. If you look at the capex, you will grow your capex at the rate at which your operations are growing. And if you look at your liabilities, the similar thing, where there is a growth of capex needed, you go for long-term liability. Where there is a uh, growth in operations required and there is a working capital deficit, you go for short-term borrowings. Then you have the equity, which funds the whole thing, and it also tries to take away the profit. So balance sheet is always secondary, but it still has its importance and impact on the cash flow analysis. But the operations or the projected financials, are the projected P&L is the most fundamental thing. So before we actually dive deep into understanding every line item, or should we even go by the line item by analysis, we need to set right certain psychological thoughts that we have as valuers. And the best part is, since we come from a profession like chartered accountancy, it is ingrained in us certain thought processes for which there might not be a direct fit for valuation. So the best parts about our profession and our education curriculum is that it helps you to understand the mechanics surrounding valuation, right? You are easily able to identify any problems that are there in the financials. You have the relevant analytical skills to decipher what is exactly happening. But because we have that auditing background, there are certain things that we need to unearth in our psychological thought process, which would be best suited for, let us say, auditing and taxation profession, but it will hinder our growth in professions like valuation, in disciplines like valuation. So let me take you through the psychological fallacies or the cognitive dissonances that we will be having when we take up valuation. The first one is this logical fallacy called mean reversion. So, what is mean reversion? Mean reversion is this thought that everything comes back to average. Let us say a company has been having very uh, aberrant growth rates or very inconsistent growth rates. Like, for example, in one year it grew by 80%, in the other year it shrinked by 40%. Following year, 30% growth, for another, the year after that, maybe a decline by 40-50%. So when we have these kind of aberrations in the growth or the volatility in the growth, to make things easier and explainable, people tend to do something called as averaging it out. So I will take the past 5-6 years of growth rates, average it, and tell, for me the next year's revenue growth is, let us say, 8%. But there is a history of the company growing at 40-80% and falling by 30-40%. But because we will not be able to take a position whether in the next year it will grow at a tremendous rate or it will fall heavily, we will average out, and the average number will come to a very small number because it would have considered both high and low in the cycle. And we would have gotten a small growth rate. And we would also justify it by saying things like, okay, I have done some sort of a weighted average, or it is the most probable scenario. But at the end of the day, we will never admit that we cannot actually predict the quantum of growth. So admitting the fact that we cannot really quantify the growth because there is so much volatility in the history, and now starting to look from a different angle as to what are the drivers that give it a strong growth and what are the drivers that will make it fall. That is a better thinking pattern for valuers. That is, inspecting the years in which growth happened and understanding what happened in those years, and inspecting the years in which fall happened and understanding what really happened there. So that is a better thinking pattern than trying to find a arithmetical explanation as to what your following year turnover should be. This is also like mean reversion sometimes is also like called as a gambler's fallacy, because there is another thinking pattern. That is, if there has been a history that if one year the company goes high, the following year the company falls down. If there is a alternating year pattern, uh, the and let us say that just the previous year that revenue has gone up, we may fall into the trap of predicting and saying that the fall will come down. That is the trend. Uh, but this is a gambler's fallacy. For example, let us say in a cricket match, at the toss, right? The past 5 times, let us say India has been part of the match and the Rohit Sharma has called the toss. Let us say he has called tails once, but it actually ended up being heads. And the following time he calls it heads, and it ended up being tails. The next time when the toss happens, Rohit Sharma may want to predict, okay, first it was tails, then it became heads. Next, it should be tails because last time it was heads. So if Rohit Sharma does that, he may call it tails, but statistically speaking, whenever a coin toss happens, it is always a 50% probability, 50-50 probability. And you cannot err by in the next toss. So gambler's policy is that, and they call it the gambler's policy because uh, a gambler who is stuck in the chakravyuha of gambling, where they believe that if they have lost 10, 15 times, the 16th time or 17th time is their chance to win. But they don't realize every time they go to the gambling house or the horse racing stadium, it is a fresh new entry. It is a new sample that they're building. The outcome of that is not determined by the past. So all of this elaborate explanation I'm giving is because every new financial year, every new financial period that is ahead of us for which we need to predict has no relation to the past performance. We need to see the numbers from a fresh perspective and understand what the company is actually doing in that year and not fall for the gambler's policy, and only look at objectively the empirical data that is available that has the ability to predict the future. For example, signed contracts or signed sale orders are a empirical data that you can rely on for the future revenue projection. But you cannot rely on past year's revenue and say, no, last year it was 100 crore revenue, so this year it should be 100 or plus. That is a gambler's policy, right? Next is, this will directly hit us chartered accountants home. Conservatism yields a lower value, but it does not yield a fair value. So I have interacted with many valuers, especially valuers from our profession, who always complain that when the management provides the projected financials for carrying out valuation, the projections provide a very rosy picture. They are very aggressive projections, very high growth rates. And invariably, all of our my professional brothers and sisters, they will end up saying that uh, this is not likely to happen, and it will be the projection, the projected revenue number must be much lower, but they have given 250% growth rate in the previous year revenue, and then 100% from there on, and another 50%. So there is always this constant complaint. I believe when you are doing fair value, there is no concept of uh, conservatism or liberalism. There is no room for conservatism, because ultimately when you're doing fair value computations, you're looking at it from an impartial angle. That is the assumptions both the buyer and the seller would input into the situation. Now, if uh, let us say the company by the promoter, run by the promoter, has a certain assumption that yes, the company's revenue will grow by 300% or even 500%. It is an assumption that they have made, and they are the seller in the market today. If they're either raising the money or if they are the shareholder of the company, they are the seller, and that they know, being a seller, they have that intelligence as to what their company is worth, and that is why they are keep pegging the revenue at a certain number. Now, is the job of the valuer to say no, it is not possible, or and pass judgments that it is not possible? That would be wrong, because then you are unfavorably uh, leaning towards the buyer for them to get a better valuation. So we should always ensure that we don't fall into this conservatism. I would, but a boon auditing profession. Conservatism in auditing and accounting is the must and should, but in terms of valuation, it becomes a curse for chartered accountants. So conservatism doesn't yield fair value; it yields less than fair value. Our job as valuer would be to understand what is fueling the growth. What is the story being written by the promoters? So if a promoter is telling 500% growth rate, it is our job to just understand, is he just a serial liar or a sociopath, or is he actually writing a story in the back end that will enable achieving such numbers or such aspirations? That becomes the job of the valuer, understanding the story that the promoters are writing. Then the next one is, on one side is the conservatism that is an asset of the buyer but a curse of the seller. On the other, the liberal growth is the asset of the seller but the curse of the buyer. Liberal growth always requires immense amount of growth capital. Um, as I told you, if there is a 500% growth that is being projected, we also need to understand why that growth is happening or why that growth is going to happen. Is it that they're going to invest in capex, or have they already invested in capex which is going to get monetized in the following year? Is it a new IP that is into coming into picture, or is there fresh talent that is getting acquired? Is there a new marketing or a sales strategy? So these are the things. Basically, if there is a growth, there is a cost to that growth. That cost can either be a P&L item or a balance sheet item in the most simplest of terms. So liberal growth requires growth capital or fuel to grow. This is the third fundamental philosophy that I would like to propose at the beginning. So the three fundamental philosophies that I would like to propose at the beginning of the session only is: avoid mean reversion or gambler's fallacy. Conservatism does not yield fair value, but it yields below fair value, which is not your objective. Third one is liberal growth always requires growth capital. So these are the three fundamentals that I would like to propose at the beginning of this session. All right, with these perspectives in mind, let us first look at how to analyze financial models of early stage startups. Then we will slowly move on to other industries as well. But early stage startups are always a little difficult to assess because you do not have any historical track record in terms of understanding how operations move. The promoters may not even be able to predict something beyond 24 months or 36 months. It is up to you to see how the story is being written. After 12 months in a early stage startups, everything else becomes a speculation, because after 12 months, it is just aspiration catching. It has got nothing to do with what is there today as an empirical data that drives the future revenues. So now I would like to help us discuss some of the variables or some of the metrics that we can look at to in analyzing the financial models of early stage startups. So understanding the story is one of the most key principles when we do valuation of young companies or startups. So in a millions, and internet not even being adopted heavily all over the world, let alone in the West and the US, where internet penetration was very low. Coming off of a back of a dot-com bubble, Amazon was your typical early stage startup. 8 to 10 years later, they had seen tremendous growth where it had become a household name in the West, especially in the US. Half a decade later, it became a household name, not just in the developed economies, but as well in the emerging economies, including our Bharat. Today, Amazon is irreplaceable. Uh, we are hoping, of course, our government's initiative of ONDC will kickstart and Bharat will have its own marketplace, which is unbiased and not controlled by a Western monopoly. But the that was the growth story of Amazon. If you went back to Jeff Bezos, if you get in a time traveling machine, go back to the year 99 or 2000 and asked Jeff Bezos whether he had imagined all of this would happen over a couple of decade and a half, being one of the most valuable companies in the world, he would have probably said yes. For us, it is tough to imagine, but that is the vision of promoters. They know that what they're doing, they will get there. And I'm talking about promoters with conviction. So Amazon back then, even though it was out of his own parents' garage, it is where it is today. And even when he was in his parents' garage, if you would have spoken to him, he would have probably said yes. So understanding the story and listening to the promoter becomes the key fundamental. And for that, we need to look at the problem solution analysis. Just a moment. I think there is a problem in my video. Just give me a moment. Hope my video is all right now.
Your PPT is right, but your video is not correct, sir. Actually, close your video and yeah, carry on with your PPT. Right, close
Yeah.
your video.
Okay, I'll shut my video. Okay. So
It's fine, sir.
yeah. So the understanding the story requires us from a valuation perspective. What is the problem solution statements that are being made by the promoter? So what is the problem in the market today? What is the solutioning being done by the promoter? And if you look at the revenues today, it will just be a few lakh of rupees, or sometimes they would have just hit a crore. But whether those small revenues can in the future become hundreds of crores of revenues, that is big revenues. Whether losses can be turned around to become profitable within a reasonable time span, or it's going to take a longer period for the company to turn around its current losses to become profitable. And ultimately, where will the company reach? That becomes the key understanding. That is, there is a certain company today. What is its aspiration? What is its benchmarking for it to reach? These are the four fundamentals that in an early stage startups, sometimes pre-revenue startups, we will have to analyze. I know the topic of the discussion is financial modeling analysis today, but if we do not have this background, analyzing any financial model will not yield us any result. It's not just about the numbers, it's the qualitative side as well. So what we can do is the problem solution analysis, we can look at it. I was able to access some of the pitch decks of some famous startups when they were very early on in their game. That is Airbnb pitch deck I was able to access when they started out in the late 2000s, and even company like Dropbox. So when you look at the Airbnbs, they used to call it Air Bed and Breakfast. Now, after a couple of rounds of funding, they call themselves Airbnb. They rebranded themselves, right? So Airbnbs, if you access their pitch deck from before, they say the problem statement. These are the problem statements. Price is important concern for customers. Hotels leave you disconnected from the city and its culture. And there is no easy way to book a room with a local or become a host, right? So price is, especially for us Indians, whatever may be our financial position, for us, if there is always a better deal, we feel good about ourselves. And they recognize this problem not just in Indians, but people and classes across the world. That is, price is an important customer. Hotels leave you disconnected from the city. If you walk into any hotel across any tourist destination in India, most likely the hotel will have the same look and feel as any other hotel in any other city. So there is a disconnect from the culture of the city, and there is no easy way to book a room with a local. That is, if there is someone with an empty room or a house, there's no easy way to do it. So the solutioning came from them is you save money when traveling, you make money when hosting, and you share the local culture of the city. If you give access to a web platform for a homeowner to host their property. So this was their problem, this was their solution. And I'll take you through one more. And before we go there, if we analyze Airbnb when it was an early stage startup as against a mature company today, and if we would like to take a moment and analyze, if we are to build the projected financials of the company using this problem statement and this solution statement, how would we go about it? If you look at the problem statement, there is one clear player in the market to whom Airbnb wants to disrupt, which is hotels. Hotels leave you disconnected from the city and its culture. So, hotel. So, their main target competitor is hotel. So, that means this business is growing on the back of capturing the market share of hotels. And then they have also given the multiplier, which is the price. So the market captured whatever is there by hotels, capture that market and multiply by your competitive price. That is your gross top line that you are going to make. So this made it very easy for investors, analysts, and even for the company promoters to truly understand the business model of the company and to predict or forecast the performance of the company. So, if you are an Airbnb analyst, you can either do a top-down analysis or a bottom-up analysis. A top-down analysis is ability to capture a X% of the world's hotel market share, understand where Airbnb will be in terms of its market dominance 10 to 15 years down the line, and work backwards to understand what will happen in the very next year and the year afterwards, every single year, until a certain end goal is met in terms of X% of world's hotel market share captured. Then there is the bottom up analysis, that is, instead of looking at it 15 years down the line, I'll start looking at it right from tomorrow. So let us say today I am just operating out of metro cities in India, that is Bangalore, Chennai, Mumbai, Delhi, and Kolkata. You start from there, and let me say I will go to the tier 2 cities, tier 3 cities, and then slowly I will go outside India and then other major cities all over the world and emerging cities all over the world. That geography wise expansion plan and growth in number of properties. Today I am having 110 properties. I would like to reach 500 properties by the end of the year. These are the bottom up analysis variables that we can track. I am giving this example of Airbnb, but whatever is the subject startup for which you are analyzing the financial model, you need to understand the top line, how it is being done. Is it a top-down analysis, that is, they have some market-related intention in terms of capturing it, or they have something called as TAM, that is the total addressable market. So are they driving their financial model from a perspective of TAM, or are they doing a bottoms-up analysis? more often than not, something that is done on a top-down analysis um, tends to get things wrong sometimes, uh, and it tends to make things more liberal than they are, right? So your total addressable market is basically, I mean, when I say TAM and total addressable market, it is your number of customers who are within your target profile multiplied by what they're willing to pay for a particular year. That is your total addressable market. That is the market that is out there for you to capture. For example, for us, chartered accountants, we can define our total addressable market by a simple thing, right? So if your CA practice or a CA firm is targeted towards MSMEs, your total addressable market is MSMEs multiplied by the fee that they can afford in a financial year. That becomes your total addressable market. Uh, so total addressable market is a percentage drawn from the total addressable market becomes a top-down analysis. Um, Top-down analysis is good for high-level analysis. Let us say when you are doing valuation of a company for your own hobby or your own interest in investing a company in a company, uh, and where you will not be having the micro level data or the granularity of data availability, then top down analysis is a good approach. But where you have the granularity of data, there is large amount of data being maintained by the startup or the company, bottoms up analysis is the best way to go, because you would be really be able to predict almost like a weekly basis what would be the growth. So, for example, if you're operating out of certain, let us say, metro cities, and you want to go to the next uh, emerging metro city, like something like a Pune. I don't know whether Pune is called a metro city or emerging metro city. I heard it definitely has a metro coming up, and it is under construction, and few stations are functioning. Um Let us say Pune market, if you want to expand into it, you can really be able to predict day by day, week by week, what exactly you need to do so that your operations can go to Pune, hiring people, hiring contractors, setting up an office, getting through the registrations, um, ensuring your marketing kicks off. And ultimately, if you're standing on day zero, you can easily be able to predict within 90 days or 80 days, I will be operational in Pune. That gives us that bottoms up analysis where for 80 days, what is the fuel that you need to pump in for those 80 days for the Pune branch to get established, and from Pune for the growth to kick off, how many more days are required? And what is your target customer base there? How many customers can you land on a daily basis? It becomes quite easy. So bottoms up analysis goes into very detailed granularity. But if bottoms up analysis is not available, a top down analysis still suffices, where you take the addressable market and arrive at a percentage of the market capture. So the next one, problem solution analysis that we can take a look at is that of Dropbox. When I first discovered Dropbox, I think in 2012, it blew my mind because I was so used to just using pen drives and CD drives, CD-ROMs and DVD drives, where to do any file sharing, either you use email, but if the size of the file is too big, then you use a pen drive. So in 2012, when I discovered Dropbox, I was surprised you can transmit hundreds of GBs of data uh, without having to use any hardware solution. Um, so Dropbox got its first fundraise back in 2007, uh, where you can see it's a pain to share files on multiple computers. Working across multiple computers is a pain. Because back then, now today we have taken it for granted, things like Google Sheets or even MS online Excel sheets, where you type in something and your counterpart, who is maybe hundreds of kilometers away, can at real time see what you're doing in a particular Excel sheet. It is taken for granted. But back in 2007, it was a fantasy land to see someone work on a single file at the same time, sitting uh, thousands of kilometers away. Um, Dropbox enabled that, right? It enabled large file sharing of files, real time working on the same file, protection of files, backups, and all of that. So if we have to analyze Dropbox in 2007, and mind you, we will definitely go wrong, or we may go wrong in its prediction in terms of whether it will succeed or whether it will fail, whether it will get competition, whether it will be a monopoly. Because Dropbox today is not being used as much as something like Google Drive, OneDrive, or even Apple Drive. Uh, uh, Dropbox is very hardly seen these days. But back then, this was a unique solution which was slated to be a monopoly. And if we had to do a top down analysis, we would have probably said that they would make pen drives, DVD ROMs, and CD ROMs, uh, legacy drives which are kept in museums, right? They would consolidate storage. They would be as large as the storage solution companies all over the world. But Dropbox didn't turn out to be like that. But if you had made that prediction, you wouldn't be wrong in the sense that it is going in that direction, because today's DVDs and pen drives are hardly used. But it was not done by Dropbox, but the industry evolved to do it. So today, our OneDrive and Google Drives are very much part of our lives, and we don't even consider it. We are not even grateful for them anymore because they have become so easily accessible for us. So when we have to predict Dropbox in 2007, we would probably give it a very high runway in terms of its revenue. So if we have to look at some of today's startups and see uh, where they would reach and what they would do. And I'm doing this typically because early stage startups predicting revenue, you do not know when to stop, where to stop, and how much at what number you need to stop. You start from 10 crore today's revenue. Should you go to 1,000 crores, 10,000 crores, or a lakh of crores, or just stop at 50 crores? You would never know, right? So what you can do is when you look into the story. So I looked into the story of Airbnb and Dropbox. Airbnb was dominating hotels. Dropbox was dominating storage solutions like pen drives and DVDs. So today's startups, whom are they trying to compete against? What is the market that they would take? And Professor Damodaran gives that famous example of Amazon. Amazon back in 99 or 2000, when you look at it, when you're trying to predict the future of Amazon, they most probably would want to disrupt the market that is held by the Walmarts and the Costcos of the world. And they did do that, right? Amazon today, you can buy anything from groceries to tools to gadgets, whatever you want, which is typically what and is being done by Walmart and Costco today. So there was a capture of the market there where people would want to stay at home and order these things rather than go few kilometers away in their cars, make a day out of it, lose a half a day just for shopping. They disrupted that market. So today, if you look at a few startups, I don't know whether this first startup that you see is available only here in my hometown in Bangalore, which is Rare Rabbit. Rare Rabbit is a startup that specializes in men's luxury fashion wear. So their shirts and t-shirts or their wear are all very unique, and their pricing point is much higher than the average prices, right? So Rare Rabbit today is not a big company. It is a small to medium sized company with a few outlets here and there. But if you look at their aspirational reading, they position themselves in the high luxury streets of some of the most happening cities in India. That is, uh, in Bangalore, if you walk into the happening road of MG Road, you will find Rare Rabbit. Um, and if you happen to go into some of the high end luxury airports, Rare Rabbit would be found. So it looks like their main competitor today are these high-end luxury brands like Louis Vuitton or Gucci, or Bulgaris of the world. They are trying to disrupt that market. So when you're looking at projecting the financial statements of Rare Rabbit in terms of its top line, it becomes pretty apparent that their comparable companies are these large companies which have established luxury brands. Um, then, if you look at Ather, the electric two-wheeler vehicle market today, I mean, these are becoming quite prevalent along with Ola electric scooters here in Bangalore. And if you read the uh, aspirations of Ather promoters, or if you look into their published materials, it's quite apparent that they want to make their product more available across the market in India. So their aspiration is to become as big as, let us say, Hero Motorcorp in terms of two-wheeler market. Uh, so sometimes these uh, startups will have this direct comparable, which is a large mature company. And startups, the only difference between a startup and that large mature company is that a startup would want to get there as soon as possible. Ather would want to become a Hero Motocorp in terms of its market share, maybe by in the next 10 years. Ray Rabbit would want to be the Louis Vuitton and Bulgaris of the world, maybe within the next 5 years. So that is the kind of rapidity and the aggressive growth plans startups would generally have. Uh, now, many times what will happen is a startup may not be wanting to directly disrupt or take a market position of an established, mature company, but rather they would want to create a niche market for themselves, or they want to take a very toned down version of the larger entity. So today we have this startup called Zepto, which promises 10-minute delivery of groceries or any items at your doorstep. And their main uh, selling point is the fact that they provide convenience. Now, one of the largest players in India today in terms of groceries or fast moving consumer goods is DMart. So would I make an error in judgment saying that Zepto would become the next DMart? Uh, Probably not. Zepto, in terms of its size, would always be a snapshot of the DMart story. DMart services the larger, wider market, but Zepto knows that it filters down into the few basic target customers who are um, willing to pay, let us say, a little delivery price, or who are, let us say, willing to let go of some discount on products for the convenience of getting the product to their doorstep. So that is their target market. Similar to another social media story called Pinterest, right? Would I make an errant judgment, say that Pinterest would be the next Facebook or an Instagram? Probably not. So Pinterest would only be a snapshot of Facebook in terms of the niche it creates. Pinterest is for people with an aspiration into art, crafts, or anything that is related to design. And as you know, 80% of the 80 or 85% of the people on Pinterest are women, right? So their target customer profile is sort of defined, but while Facebook does not create that niche, right? Facebook is for everyone and anyone. So when we are doing that, uh, this whole discussion is actually around benchmarking. So in my previous thing, Louis Vuitton and Rare Rabbit, let us say Louis Vuitton is at 10,000 crore of revenues for India. And I'm taking a placeholder number because I don't know how much Louis Vuitton makes in India. So 10,000 crores of revenue. And let us say Rare Rabbit, if we are doing projections, maybe in 10 years, Rare Rabbit would also hit that revenue because that is what they want to become. Uh, so, working backwards on a target becomes quite fundamental. Just give me a moment. Yeah. So, if we look at the projections of revenue I have taken one example company. If you look at the projections of revenue over here, let us say if you work backwards basis this model, that is, you have an early stage startup, there is a role model that can emulate your startup's growth story. Considering that, let us say that in an example case, today there is a startup. And if you work backwards on the role model of that particular company, the target revenue is about 250 crores in about 10 years. Today, they are in operational losses, but their target operational margin is about 10%, right? So if you look at it, the trailing 12 months, that is the past 12 months revenue was about 4 crores. And year on year, you can see that there is a growth 150%, 125%, 100%. And ultimately, by the end of year 9, it is growing at a very slow pace. That is a terminal pace or a long term sustainable pace. And it is reaching its target revenue of about 250 crores. So when we are scrutinizing this revenue line items, earlier we discussed the top down analysis and the bottoms up analysis. Along with that, an aspirational pegging, that is an Aether becoming a hero, or a Zepto capturing a percentage size of a DMart. Let us say Zepto wants to become 30% of DMart size because it is capturing a niche audience. It becomes quite easy for us to sort of make an explainer later on in terms of the year on year growth. Ultimately, by the time it reaches its target revenues, uh, uh, the growth rate should have become normalized and it should be reaching a long term growth rate. So in India, the long term growth rate is about 7% as of today. And how do I say 7%? Because um, the 30-year government of India bonds yields about 7%. The long-term inflation is at about 7%. So the expected minimum nominal growth is about 7% in the economy, right? Uh, so usually when we do terminal value calculations, you can take up to 7% if you are using these logics, right? So you start from your 7%, and if you are not finding so much promise, you can keep going 1% below that or few percentages below that. But whatever long-term terminal growth rates you're using, your last year of projection must come close to that growth rate normalization. So you start from a high growth rate and you ultimately taper down towards a long-term growth rate. So in our example, if 250 crores is the benchmark revenue that the company intends to achieve over a period of time, the growth rate in the initial years can be higher and it can taper down into the lower side, which makes it easy for a logical explanation. Then it comes to operating margin percentages. When I say operating margin, it is basically EBITDA minus depreciation. You get operational margins, right? So in our example today, the company is at about 37% of operational margins, negative 37%, and the trajectory with which these operation margins grow plays an important role in what valuation you will actually get. So let us say you start off with a negative 37% of operational margin. If the company has a very robust plan to turn back these negative losses into positive profits, there is a certain valuation that you will get. But if you think as a valuer that there is much more pain in the company that is yet to come, and after the period of pain, uh, then in the later years when the company is about to mature, that is when it will start to hit profitability. The valuation actually comes down drastically. So in our option one, the company becomes profitable by year 3. But in the option 2, the company becomes profitable only in the year 7. And what this would lead to is in option 2, the valuation number that you would get would be quite low in comparison to option 1. But hey, here's the deal, right? In option 1, where is your growth fuel coming from? Because the operation margins are becoming profitable faster, I am assuming the growth margins, I mean, the fuel for the growth is coming from CapEx standard. That is why it is not having too much impact on the operational margins today. Yeah, of course, depreciation does play a role, but depreciation does not have as much impact as a direct write-off of a capital item in the revenue or in the P&L. In option 2, what might be happening is the growth fuel may not be capex, but rather things like uh, new talent, marketing costs, or sales costs. These might be the driving factors in option 2. So we really need to understand what is the fuel that is actually driving this operational margins. So working backwards on a target, it's always fun to do because you know where to get to. But once you know where to get to, explaining everything in between becomes our job. And if we fine tune a few things here and there, valuation numbers keep being volatile very highly. I mean, a small fine tune of certain growth rate in a certain year can change your valuation by a very huge margin. Um, so that working backwards becomes the key important task. If you're doing bottoms up analysis, a few important metrics and analysis that you can ask the management for you to be providing are churn rate, retention rate, your average order values, your cohort charts analysis. So here you can see that I have put across for everyone's benefit a small cohort chart of an app-based business of the number of users and their number of active users. So how we typically read a cohort chart is that if there are in the first row, you can see in January 2025, there were about 1,000. It's not January 2025, it is January 25th. Sorry about that. So if there are 1098 users to begin with, in day one, 1098 suddenly dropped down to 34% of active users. That is, on day zero, they downloaded the app. And the following day, the number of active users, number of users that are actively engaged with the application was just 34%. And the same unique users, from 34%, it became 23.5%, then 18.7%. And then finally, by day 10, out of 1,098 users, only 12% of the users were active. This is as on a particular day. Now on January 26th, the same thing happened. January 27th, like this, 28th, 29th, like that. You can put out from day 1 to day 10 what was the engagement of the users with the application. So, and if you look at the average day 1 engagement by users is about 27%, and average day 2, day 3, like this. And day 10, of course, there's only one sample size because this is done only for 10 days over here. But these kind of charts help us to analyze the behavioral patterns of the consumers. And from there on, we can see whether the projections made by the company are reasonable. So, for example, in this case, from about 13,000 app users, 27% of them would actually be active on day 1. But if their assumptions consider a higher percentage being active in terms of app usage and thereby it getting translated into revenue streams for the company, what would fuel a higher percentage? What would the company do differently to change this metric from 27% to, let us say, about 50% or 60%? What is that fuel that is getting translated into financial numbers within the P&L or the balance sheet to enable that uptick from 27% to a 50%? Right? You can see those fuel going everywhere. And further, the fuel can also be seen in the acquisition of number of users. So if average number of users or total number of users over a 10-day period is 13,000 users. But if the company is projecting, let us say, 35,000 users in a 10-day period, what is the company doing to get more users on board? What is the company doing to engage more users from day 1, or let us say engage more users by day 10? So these are the kind of fuel that we need to see. And this is known as a cohort chart analysis. Here you can get to know the churn rate, the retention rate, and more detailed cohort charts can be drawn up to understand what would be the size of the transaction, what would be the average order value in B2C companies. Another analysis that we could do, which are generally done by venture capitals, is by looking at what is the average lifetime value of a customer with customer acquisition costs. So how do you, first of all, let us reel back and understand how do you even compute a average lifetime value? An average lifetime value is computed by taking, let us say, you a customer, or let us say we are an application user. We are using our most recent example, Zepto. Let us say we got into Zepto through a referral by a friend. So usually in new age businesses, there is always some sort of a referral bonus that is given to the user who referred and also the new customer who came on board. So let us say the friend of yours got some 200 rupees voucher and you as a new user got some 100 rupee voucher. So the customer acquisition cost for you to acquire you as a customer became 300 rupees. So of course, if we are looking at the number of users and its marketing cost and sales cost, that 300 rupees should be somewhere translated in the P&L. So that is one of our line item of scrutiny. But now you as the customer has come on board. Now, how does the company assess your lifetime value is basically, let us say Zepto makes about 5% margin on its orders. That means for every 100 rupees of order that you place on their app, they make 5 rupees from it. Let us say that is the margin that they make. So lifetime value is nothing but your average order value. That is how much you are going to spend on the app, on Zepto, multiplied by the margin of it, that is 5%, multiplied by how long are you going to be with the app. That is, are you going to use Zepto for 3 years or 4 years or 5 years? So there is a metric that is usually followed by venture capitals. So when they take your average lifetime value, that is, you spent about, let us say you made the company about 900 rupees in margin money, that is the revenues, the net profit that they earn, about 900 rupees. They spent about 300 rupees acquiring you. So 900 divided by 300 becomes a 3x multiple. That is, they make 3x the money that they spent in acquiring you. That is your average lifetime value divided by customer acquisition costs. So generally, there is empirical data as well as there is popular practice followed by venture capitals. That is, if your average lifetime value divided by customer acquisition cost is less than 3x, then the company is unsustainable. It is expected to shut down after a few years. And I think this is what happened with Dunzo as well, because their average lifetime value per customer was very less. And that is why today Dunzo is struggling and they need a lot of money they need a lot of dry powder to keep the company going. So less than 3x becomes unsustainable. 3x to 8x is considered the sweet spot where a startup can be slated to become hyper successful. But anything above 8x, venture capitals do not like the promoters who have companies which have more than 8x. And it is such a irony that is, if you're making more profit per customer, the VCs are not happy about it. And the reason is quite simple. Their thinking is that if your lifetime value divided by customer acquisition cost is greater than 8x, that means you're not being aggressive enough. You have a lot more margins to play with, but you're being more safe and not taking risk by investing in aggressive expansion and growth plans. So that is why usually VCs see 3 to 8x as the sweet spot from lifetime value to customer acquisition cost. And anything above 8x is that the company is not aggressive enough. So when we look at the projected financial statements, we can see how the sales and marketing costs are faring against the top line revenue. So in case if it is less than 3x, we know the company is unsustainable. In case it is greater than 8x, and if the company is heavily VC funded and startup funded, we know that the VCs and the private equity and the angels will not allow the company to maintain higher than 8x LTV by CAC. So 3x to 8x would be that sweet spot we need to look for in the projected financials. And here I'm talking about early stage startups, but as and when the company matures, let us say 5-6 years later, this number could become higher than 8x. I am only talking about in the growth phase before the company reaches a stage of maturity. You can do further customer lifetime value analysis. For example, if 60% of the active customers are profitable, and 20% of high value customers are heavily profitable, then you are deriving 80% of the company's value from a few of these customers. So doing this analysis also helps us in understanding what is the average profitable customer look like, what is a proactive customer profile look like, And what is an inactive customer profile looks like? Is the company projecting higher active customers, higher profitable proactive customers, or higher inactive customers? And if they are doing any of that, we need to see what are the action points that they are undertaking in the backend. What is fueling that? Higher profitable customers require higher or better fuels that are required to drive the startup. Another few metrics that we need to look at, we can value a company, we can look at the projections of the next 10, 15 years. But if the company does not have a plan or a runway over the next 10 to 12 months, its own existence may be questioned. So looking at burn rate and runway becomes quite important. The burn rate lets you understand what is the uh, uh, money that the startup is losing on a month-on-month or a weekly basis. And runway is basically, if you are following this burn rate, how soon will you reach day zero? They call it day zero because that is the day when cash in hand and cash at bank becomes exactly zero. So how far is the day zero for the company? At the current burn rate, how soon will the company run out of cash? And before it runs out of cash, does it have a fundraising plan in the charts? So if the runway is less than 10, 12 months, the company should have already have an active fundraise plan ongoing. Because generally, companies will take about 6 months to close a funding round and another 3 to 4 months in finding the investor. So once you find an investor, you at least need 6 months to close the investment round with both in terms of diligence, in terms of legal requirements, in terms of money actually coming and hitting the bank account. Anything less than 6 months would be an aspirational number. So 6 months, 4 months to find the investor, 6 months to do the thing. So 10 to 12 months. So if the runway is less than 10 to 12 months, the company should have an active investment seeking plan already in the charts. So finally, what matters is that what we have already discussed is what is fueling the growth in the projections. And finally, whether the growth tapers down the closer the company is reaching maturity. So these are the two important factors that we need to look at when we are projecting revenues in startups. So before I go into industry peculiarities, if there are any questions the moderator has collated, I am open to take.
Yes, sir. Actually, we have few of the questions from the participants.
Yes.
The very first question is, are there potential cost saving measures or efficiency improvements factored into the projections?
Cost saving measures and
Efficiency improvements factored into the projections.
So let me just break it down into like this. So now I have been in a startup kind of a mindset. So I need to, this cost saving and efficiency are matters of medium to mature companies mindset. So if you look at, let us say a manufacturing company, right? Cost saving is achievable if it has been achieved by other mature entities. That's how I would like to put it. Let us say you start a paint manufacturing company today. There is lot of inefficiency because there is a learning curve that needs to be attained to reach a high efficiency level. So your aspirations would be the Asian paints or the Berger paints of the world, where there is a certain efficiency met. How long will you take? How long did they take? Can you cut down on their learning and come to a faster uh, learning model and achieve higher efficiency? This is for your typical manufacturing entities. When it comes to, let us say, startups, B2C startups especially, achieving efficiency would always be their goal from day one. So, in terms of achieving efficiency, it translates into a higher operational margin that we discussed about earlier. Higher operational margins are achievable if and only if your fuels that drive the growth are made efficient. So the efficiency factor must and should be factored in. Ultimately, if the company is in early stage and it is reaching a mature stage at a later point. But if you're already a mature company, further tuning in efficiency becomes little difficult. I hope my answer was satisfying.
Yes, sir. And the question is, which method is best, DCF or EBITDA multiple?
Okay. So I would not like to comment saying one is better over the other, but rather I would say what is applicable when. You are, let us say, looking at an early stage startup with a negative EBITDA. How can you apply an EBITDA multiple to it? It is not possible because the number itself is negative. Let us say EBITDA multiple in the industry is 10x and you are negative 40 crores. Can you say my valuation is minus 400 crore? That is not possible, right? So EBITDA multiple or any comparable company multiple or industry multiples are applicable on little mature companies or little later stage companies in terms of even startups. So I will give you an example, right? There is this famous hospital group in India, Manipal Group of Hospitals. Recently, they were valued at 40,000 crores in the market. If you drop the DCF, it may not be possible to achieve that number over the next 5-6 years. If you have a 5-year forecast, it may not be possible because they would have had to require a tremendous growth rate. But if you apply a certain revenue multiple or EBITDA multiple, you may come closer to that 40,000 crore number at which the transaction happened with a Singapore-based venture capital fund. So EBITDA multiples are good in certain cases, but what you get from a revenue multiple or EBITDA multiple is not a fair value. It is a price. So there's a difference between pricing and fair value. I believe I'm a valuation purist. I believe if you are doing fair value, for me, other than DCF, nothing else yields fair value. If you're closing a transaction, you need something to do negotiations with, then you have to be smart enough to know how does pricing work, what is revenue multiple, and what is fair value. If you're doing investing for yourself as an investor, and you want to know the deep fundamentals of the company, and you want to take position on certain assumptions, your DCF model will help you. But if you are an investor who is into trading, who is into value investing, who wants to just go and see whether the market is meeting its expectation, then your pricing basis is better. So to close transactions, to do negotiations, multiples are the best. But if you are looking at the fundamentals of the company, income approach is the best.
So the next question is, how sensitive is the valuation to the changes in projected sales figure?
So if you look at it arithmetically, right, the earlier years in the projections are quite sensitive because you're closer to the nearest year, closer to present value. So the discount rate applied will be very less on the following year and the year after projections. But the later on years are become less and less sensitive because any which ways it will get heavily discounted in the later years. So your ability to project the next 2 to 3 years of revenues and the margins from there on as close to possible as reality or reasonable becomes key. Later years, your room for error or the tolerance for error will grow because the discount rates are higher. But in the nearer years, your room for error becomes smaller and smaller. So your prediction for the following years must be extremely reasonable. Yeah.
Sir, we have few more of the questions, but do you want to continue with the session?
I can take maybe couple of more questions. And can you also let me know what is the time now? How much time we have left?
It's 11:33.
Okay. All right. Then I can take one more question, then complete the thing in 20 minutes, and then we'll have another 10 minutes.
Okay, sir. So the very next question is how to value the future value of AI under startups which do not have established track record or any peers.
Okay. AI related startups are excellent, right? It gives you. So I recently valued an AI startup which was in the business of chatbots. That is similar to your chat GPT and all, but for a specific use case, that is, they want to be a chatbot for the regular users in their ERP systems. Um, so usually if there is any problem in ERP systems, what we end up doing is calling up the call center or customer support service and ask for solutions. Um, Now, if an AI chatbot is able to meet, like, let us say 99% of that problem, then you can know that the pegging that you could do for this disruption is majority of the call centers will get shut down. And the call center may employ just one or two people. So that is your market capture. So when we look at AI, my suggestion from based on my experience, because I've valued some 3-4 AI companies till now, early stage companies, is that we need to look into the industry that it is going into and the disruption it is causing. And if you look at it, I have a very fascinating. I read something very fascinating about how artificial intelligence will disrupt the market. Right? There are two situations on what AI can do. You can think of, if you have watched the Hollywood movie Terminator, where in the future all the computer bots and machines would have taken over the world. That is one imagination of what AI can do, where everything is done by AI and computers and machines, where humans don't have anything and humans may even become extinct. So that is one understanding of AI. The other understanding of AI is the more realistic one, where in case AI is going to take over a few things, and we all know that AI cannot take over everything because it is just a set of arithmetic or logical steps in terms of code that they're actually in the backend. So AI does not have the power of imagination which humans possess. So at least for the next half a century or even a century, my prediction is we will never get into a situation where computers and AI have become sentient beings and they take over the world. So when that is the situation, and this is the most likely situation, AI startups, the best case for them is to disrupt a particular sector. And when you disrupt a particular sector and humans go away from it and machines take over it, the products or the benefits that we get from the sector is going to become cheaper rather than costlier, because less mistakes, more efficiency, higher reciprocation by AI, it will make the product or the service cheaper, and it will not become costlier. So that sector, and what gets higher value is the things that AI cannot do. For example, if we want to watch a very beautiful Bharatnatyam performance, if we train a machine and feed AI into it, the performance is not going to be so satisfying for us. In the future, self-driving cars are set to become the next big thing. But if you replace today's Formula One drivers with self-driving cars, it's not going to be as fun as it is now. You don't watch a chess match between two computers. You watch it between Vishwanathan Anand and Carlsen Magnuson, right? So there are certain things humans will do, and the things that human-driven things will become more valuable, and AI-driven industries that get disrupted, AI companies will capture that value, but that value will be discounted because you are now offering products and services at a lower price. So if there is a certain human activity that gets billed at 10,000, 15,000 rupees, AI can bill it to the customer at 1,000 or 2,000 rupees while maintaining the same amount of margins. So that is something to be kept in mind. Yes. So now Manoj, I would like to continue the presentation.
Okay, sir.
Yeah. Yeah. So now we will look at some of the industry peculiarities. I would like to start up with the BFSI sector. And BFSI is a very interesting thing to project because if you have ever like done the financial modeling of, let us say, an NBFC or a fintech company, you will never know how much growth to put because your assets under management, that is the loan book that you have as a bank or an NBFC, is limited to the sources of your fund. If your sources of your fund is unlimited, you can literally say your asset book is also unlimited, because the more sources of funds you get, the more you can keep growing. And founders of NBFC startups or fintech startups or any startups that are in BFSI sector, they do this thing, right? When you get the financial projections, it appears that there is no end point for growth in such companies. I recently valued a gold loan company, a new age gold loan company, which is showing about 800 to 1,000% growth in its assets under management. Now, I know at the beginning only I told that conservatism should not be a trait that we should carry from our chartered accountancy knowledge and curriculum into the valuation discipline. But I myself could not hold back my conservatism principles and understand how can this unlimited growth go on for the next 10 years by this company. So in BFSI sector, when you're preparing the projections or when you're doing the valuation, you feel like you're on a horse that is not under your control, because the growth is happening at such a pace in these projections. You can keep on showing more growth in loan book, you can keep showing higher interest rate, and at no point you can bring in any sense of constraint into them. See, if I'm talking about a grocery delivery company, or if I'm talking about an AI startup, or if I'm talking about, let us say, an e-commerce company, I can always think of thousands of things that can hinder back growth and bring me back to reality. But when it comes to BFSI, that too in banking in India, the first thing that they will tell is, in India, the banking sector, insurance sector, and the financial services are very, very, very less penetrated. And because of that, there is unlimited growth. So, how do you, while meriting unlimited growth, how do you come back to reality and fine tune, and what are the restrictions to the growth that we need to keep in mind when assessing BFSI companies? First is the sources of funds. So if the company is continuously showing pumping in of funds, that is not a reality, because are they getting funds from deposits? Are they getting funds from other banks? Are they getting funds from multilateral or international institutions? Whatever may it be, the growth in the sources of fund has a certain pegging. If a company wants to be a deposit holder as big as State Bank of India in the next 10 years, um, That is a respectable aspiration, but it is not an achievable aspiration because there are lot of tools at the disposal of State Bank of India or an HDFC, which this particular startup may not have, including brand loyalty. Uh, then next is the net interest margin. See, typically, even the HDFCs and the Kotaks or the ICICIs in the world, they are struggling with optimizing net margins. Um, for example, in a affordable housing sector, your net interest margin cannot go beyond 1.5 to 2%. So when I say net interest margin, it is the interest that you earn on your loan book minus the interest of your sources of fund. So affordable housing has one of the lowest net interest margins, followed by regular housing, not high-end housing loans, and then you have the farming loans, which have very low net interest margins. And the high net interest margin starts from consumer loans and business loans and unsecured loans. So this net interest margin must not be optimized for a early stage BFSI from the beginning only. Their aspiration must be to reach a high efficient net interest margin that are enjoyed by the mature banking companies of the world today. But they should not enjoy it from day one unless they have figured out a very cheap source of fund for themselves. And also, while talking about sources of fund, compliance with this net owned funds also becomes important. There is a certain minimum net owned funds that every banking company, BFSI company must maintain. So in the projected years, that minimum net owned fund must always be maintained, and their external sources of fund must not go beyond a certain limit where the minimum threshold for net owned funds comes below that. And as you know, liquidity maintenance is also important in terms of CRR, SLR ratios, and Basel norms. So they require certain capital adequacy ratios and liquidity maintenance ratios. That also must be checked in the projected financials, whether that requirement is being met, and the requirement is being met comfortably only at later stage and not at early stage. Then delinquency ratios, that is your NPA ratios, are also important. If they claim that their delinquency is much, much lower than industry players, they must be doing some things which are leading to that. And for doing things that is less to achieve lower delinquency ratios, they must have a cost associated with it as well. So those things must be factored in. Next are the cyclical industries. Cyclical industries are your non-essentials and commodities. In an economic downturn, you cannot expect BMW and Audi sales to go up because they are non-essentials. Economic downturn also leads to commodity companies having lesser output. Like if there is an economic downturn, you can expect the iron and steel output to come down. But there are a few things that will continue to happen in economic downturns, and some companies have built business models in such a way that they are not affected by economic downturns. Either they have diversified into multiple geographies, multiple types of customer profiles, or their product is in such a way that it is an essential commodity that will continue to get consumed despite economic downturns being there. So I will quickly show you the two charts over here, right? So you have the one graph of a particular stock here, and you can see how cyclical it is, right? It goes up, it goes down, it goes up, it goes down again, it goes up, again it goes down, it goes up, it goes down, it goes up, it goes down. This is a typical cyclical industry. And if you have not yet guessed what stock it is Tata Steel. This first graph is Tata Steel graph. It is a typical cyclical company. Then this is the second stock. You can see there is a very gradual uptrend with not much up and down, which with not much defined up and down curves. Uh, and if you have not yet guessed which company it is yet, it is Asian Paints. So Asian Paints is known to be one of those companies which are not cyclical in nature because they have found that their products get consumed across various economic situations. Because India has a lot of infrastructure construction to continue to happen, a lot of painting work to be done. So Asian Paints always on an uptick. Usually that has been observed and seen. By the way, I'm not making any stock predictions here. I'm not a registered investment advisor. This is just to show the difference between cyclical industries and non-cyclical industries. So when we are valuing cyclical industries, the worst thing to do is that we have started to project coming off of either a boom or a downturn cycle. When we do that, let us say we start off from a boom cycle, and if we continue to project further higher growth rates, considering the previous performance, we would be erroneous in our projection. Similar thing if it is coming off of a downturn, and if we continue to project on a downward basis, we would again be erroneous. So understanding the cyclical pattern of the industry becomes important, and identifying the key drivers on what leads to boom and what leads to bust in this cyclical industry. Is it commodity prices, economic cycles, or is it any regulatory change that leads to this being cyclical is something to be seen. Understanding what phase we are currently in and what was the phase that we are coming off of is important. What is the risk management measures for downturn? That is, companies that are cyclical and have high fixed costs or high financial leverage, that is high amount of debt, are exposed to tremendous amount of risk. But companies which are lean, which are cyclical yet lean, we can say that their risk management is quite good, because in high boom cycles, they are able to scale up, but in low boom cycles, they are able to become lean and continue to remain profitable. It is just about that hitting that sweet spot, because when you're in a boom, if you are still variable in nature, you cannot make the best use of the margin that is available. Because someone with fixed costs may make huge amount of margins ranging to 80 to 90%, right? But if you're in a variable costing kind of a setup, your 80-90% of margin may just become 30-40%, while your competitors are going, who have invested in fixed cost, would have enjoyed the higher margins. But when you are in a bust mode, when the cycle has come down, this company that invested more in variables rather than in fixed costs, they can be called as cockroach companies because they survive the downturns. But the companies that enjoyed the boom, they may not even survive because of the high fixed costs and operating leverages they may be having today. So that risk management and whether they have found that optimum mix of fixed cost and variable cost, or are they in the process of figuring it out, is something to be seen in the projected financials as well, and to see whether they would survive a boom and bust cycle if they are high in fixed costs. Then finally, scenario analysis becomes important, because sometimes cycles may not be predictable. While you are in a cycle, the pattern may not be predictable. So in such cases, doing a best case scenario, worst case scenario, and most likely case scenario, and looking at what is the assigning probabilities based on what is more likely, can help us do valuations in the best way in terms of cyclical industries. Next is cost head and margin analysis. See, generally, direct costs and gross margins must remain consistent across the financial years. If they're remaining very inconsistent, then we need to really understand what is happening. Then the second part, this was if you observe any startup that is ultimately becoming a listed entity and surviving the IPO and continuing to thrive from there on, you will realize that even in the best case scenario, even in a thriving scenario, they wouldn't have gone beyond an EBITDA of 20-25%, be it your Zomatos or the Paytms and all. Then they wouldn't have achieved an EBITDA higher than 20-25%. So if you're assessing a startup, which is in the burn stage today, that is, they're continuously burning money, going beyond 30% EBITDA is unreasonable because companies have not achieved it. It is highly unlikely. So when you're doing margin analysis, ensure that you see first the gross margins are a little consistent and EBITDA and operational margins are not going beyond 30%. If it is going beyond 30%, it is time to question the reasonability of these projections. Then headcount projection should always be in line with the growth in operations. How quickly the operations are growing, headcount must not be stagnant. If the revenue is growing by 300%, how quickly is the headcount also growing is something that we need to look into. And headcount costs also have associated costs, like rent can go up, maintenance costs can go up, staff welfare can go up, your provisioning for expenses for other expenses can go up. So headcount is important. Then recruitment training cost associated with headcount is also there. Next is, I have seen many valuers err here, which is the ESOP expenses amortization. Many times the historical projections or the historical financials, they may have a certain amount of ESOP expenses in it. But ESOP expenses have no impact on the cash. They are a notional item. They are an expense in kind and not in cash. Kind in the sense here it is the shares or the underlying security that are part of the ESOP. So when we do free cash flow computations, we must be sure to ensure that ESOP are not given any cash flow related adjustments because they are a non-cash item. And further, the only cash impact that they have is the tax benefit that is associated. ESOP expenses have been proved through multiple case laws now that they are tax benefit, they are allowed for tax benefit purposes. So the tax savings on ESOP expenses must be accounted for, while the expense in and of itself does not have a cash impact. Then the next one is the managerial cost versus salary in lieu of profit. So many companies prefer to take salaries rather than dividends. Because dividends have dividend discount and they may be subject for double taxation, that is taxed in the hands of the company as well as in the hands of the recipient. So many people, many companies, what they do is they pay their shareholders who are in the promoter level or director level positions in management remuneration rather than in dividends. So if that is also coming to the projections, it is up to us to differentiate what is this fair salary cost for the participation of that person in the management and what is the additional benefit that that person is getting because they are a shareholder of the company. So we must be able to decipher it, push the dividend component into profit after tax and reinstate the profit to include a fair salary cost rather than an inflated salary cost. Similar thing with regard to rent cost as well. So in rent, if the building is owned by the promoter, they may either charge too less of a rent or too high of a rent. too less of a rent because they want the company to be profitable, or too high of a rent because they want to root the profits of the company into their own hands. So if in our inspection we get to know that the land and building in which the company is stationed at is owned by the promoter himself, we need to reinstate the projections to show a fair rent cost rather than the related party rent cost. Finally, in the cost and margin analysis, we can do a tax rate check, see at any point in time any MAT related provisions get attracted. So there might be a situation of a book, I mean, tax loss, but a book profit may be required to be booked and a MAT provisions may have to be taken. So the tax rate check and the tax cost check must be done. So with that, we'll be moving to balance sheet items. Balance sheet items, as far as I know, there are only two things that impact balance sheet. One is the capex, the other is the working capital. Rest all is not so material for us in valuation. Capex because it fuels the growth, working capital because we get to see how the company reaches efficiency over a period of time. So high working capital can be witnessed when the company is in early stages because efficiency wouldn't have kicked in yet, but later on with better command, better negotiating power, they may be able to optimize their working capital ratios. Industry fixed asset turnover ratios can be checked in case if the company is capex heavy. And I have listed down a few balance sheet items, which I'm not going to go too detailed into because I would like to spend more time in discussing some of the questions that would have come. So there are a list of balance sheet items. I would make the PPT available through the management for everyone's benefit, whoever sees it. And you can go through line item wise what are the various checks that can be done on balance sheet items. So with that, I would like to come to the question and answer session, Manoj. So Manoj, over to you.
Yes, sir. Actually, we are actually insufficient of time, so we'll be taking only few of the questions.
Okay.
The very first question is how can social enterprises, profitable or non-profitable, be valued for investors or social stock exchange?
Right. So social enterprises. Many people have this thought that social enterprises are NGOs. So let me just decipher that thought first, and then we will go deep into it. Social enterprises are for profit companies with a social objective. Okay. For example, let us say a company is into making paper bags. Paper bags are an effective alternative for plastic bags. Now, a company who manufactures paper bags or a startup that is disrupting the paper bag industry may be a social enterprise, but it is a for profit enterprise. So, any company with a social objective or an ESG objective, but for profit, is a social enterprise. So, in terms of its business analytics, they should and must and should continue to maintain business fundamentals if you want to reach higher valuations. Because ultimately, we have seen what has happened to ESG funds, ESG mutual funds, and the kind of criticism it is drawing from all sectors. So, while chasing social objectives, the business fundamentals and the business plan must not be forgotten. But there are companies which bank on this ESG premium in claiming better valuations. It will work in the short run, but on a long run, it may not work. And to give you a few examples, ESG startups have been able to claim better valuations than companies which do not position themselves as ESG. But in terms of its actual evaluation, profitability should continue to remain if you're looking at it purely from your standpoint where you want to invest at a certain fair value. But if a transaction has already been settled and now you need to come up with an explanation for that transaction pricing, then your assumptions around social enterprises should be a little different in relation to other enterprises. Especially, I'll tell you in terms of something like DLOM and DLOC. They may not be as illiquid as other startups because they have an aspiration attached to it, uh, for investors to come and seek investment positions in it, because it has got to do more with uh, like status in society rather than profitability. So something like DLOM and DLOC and all, we need to change, make it a bit more liberal for such companies. Yes, Manoj.
So the last question that we have is, how does the company plan to fund its projected capital expenditure and working capital needs?
How does a company plan for its capex and working capital needs?
Yeah. How does it plan to fund its projected capital expenditure?
Yeah. So here, the company must be fundable in its nature, right? When I say fundable, if you are a private equity investor and an angel investor investing in a startup or a company, that investor must be able to get an exit in the future, in the sense that either through an M&A or an IPO, or through buyback, which is, we have never seen startups being able to do buybacks these days. So it must be an exitable company. So if you are planning to do capex, uh, if you want investors, if you're banking on the fact that investors will come, the valuer has to check whether if such kind of startups, if such kind of sectors have seen exit by the investor, having a profitable exit there too. If not, sometimes if you are not in a space where exits are possible, getting funding, getting entry is difficult. So if exit is difficult, entry is difficult. So valuer has to look into the fact that whether exit is difficult. If exit is difficult, the planned capex may be difficult. So the fuel growth is dependent on these variables. Yes, ma'am.
With this question, we conclude this session, dear participants. We extend our sincere thanks to our distinguished speaker, C. Anjan Babu sir, for his valuable insights. We also express our gratitude to our chairman, C. Hansraj Suk sir, and vice chairman, C. Priti Parasavla ma'am, for initiating this platform for the field of valuation and guiding us. We would like to take a moment to acknowledge and appreciate our audience for dedicating your valuable time, even on holiday. Your enthusiastic response has been a tremendous source of motivation for us for continue our journey of knowledge sharing. You can also watch previous sessions by searching Valuation Manthan session on ICI YouTube channel, ICI CATube. No unstructured CP hours will be allowed for watching previous sessions on YouTube. Two unstructured CP hours are eligible only for live sessions on Sunday. Also, we welcome your feedbacks on the session appearing on your webcast screen. Please say it with us. With these words, we thank you for your active participation and we eagerly anticipate meeting you again in our upcoming sessions. Until then, please stay informed and remain committed to your pursuit of excellence in the field of valuation. Have a wonderful day ahead and Happy New Year from our valuation team. Thank you, everyone.